Hey guys, what's up? Welcome back to another video. In this video, I'm going to be talking about a stock that recently announced earnings for the second quarter of 2023, and that stock is Adobe. And we can see that over the last year, Adobe is up a little over 30%, while the rest of the market is up 17%. So Adobe is outperforming the market over the last 12 months. And so in this video, I'm just going to look into some of the recent news that came out surrounding Adobe as well as their financial statements. And then I'm going to use a discounted cash flow model to figure out the intrinsic value per share of Adobe. And as you'll see at the end of the video, I added a couple of new features to the Microsoft Excel sheet that I use to analyze these companies. And I think it's going to add a little bit more depth and a little bit more analysis to these videos. So stay tuned for that. So right here we can see in this article, it's titled, "Is it too late to buy Adobe stock?" Some of the key points they touch on right out of the gate include the fact that their Q2 earnings easily beat analysts' expectations. Also, they raised their revenue and earnings guidance for the full year. And with all that said, the stock currently is not trading at a very cheap price, but based on recent news, they could deserve a premium valuation. So to start off right here in the article, this part's titled, "The Blue Chip Cloud Stock Just Hit a New 52-Week High." Basically for the second quarter of 2023, which ended on June 2nd, Adobe's revenue rose 10% year over year to $4.82 billion of revenue for the second quarter alone, and that exceeded analysts' estimates by $50 million. Also right here, they point out that this recent growth in their revenue brought back the bulls, and it drove Adobe's stock price to a new 52-week high. On top of that, in the second quarter, they generated 73% of their revenue from their digital media segment of their business, which includes their Adobe Photoshop, Adobe Premiere Pro, and other design applications. And then also, if I scroll down here, they give a quick little interesting table that points out their year-over-year revenue growth for each of the operating segments for their business. We can see it's from Q2 2022 to Q2 2023. And year over year, they've been seeing some very stable, consistent growth in both of their operating segments, their digital media revenue and their digital experience revenue. Total revenue has increased around 13 to 15% year over year from quarter to quarter. So that is definitely a good sign for Adobe. Also right here, they point out that along with some of the good news that's been coming out about Adobe's growth, we can see that the guidance that they gave in their earnings call didn't include any potential gains from the planned acquisition of a software startup called Figma for $20 billion. This startup company more than doubled their annual recurring revenue for the second straight year to $400 million in 2022. And that acquisition would obviously add their revenue to Adobe's income statement, and that could significantly boost Adobe's Creative Cloud revenue. On top of that, obviously, in the tech industry right now, there's a lot of hype happening surrounding artificial intelligence services, and Adobe is definitely trying to capitalize on that opportunity. They launched Firefly, a generative AI service that enables the Creative Cloud users to create images, videos, and digital models with nothing but simple text prompts. And this could expand their segment's addressable market and make it a lot easier and a lot more valuable for professionals to use their products, which would obviously make Adobe a much more valuable company. And then right here in this paragraph, they point out that their gross margin expanded to 88% for the first half of 2023. And so that gives them plenty of pricing power against their potential competitors. But on top of that, unfortunately, their operating margin shrank to 33.9%, and that was due mainly to general macroeconomic conditions currently happening in the economy right now. Obviously, there's a little bit of an economic downturn, and a lot of companies are making less money due to that. But in the future, hopefully, they'll be able to turn that around. Then right here in this paragraph, they talk about their cash flow. Their operating cash flow basically rose 5%, so that's obviously good news. It rose to $2.15 billion in the second quarter, and they repurchased 2.7 million shares. They currently have $4.15 billion remaining of their $15 billion share buyback plan, and that expires in 2024. And then to end off the article, they point out that the stable growth, the sticky ecosystem of products that they have, the potential gains from their acquisition and their new AI generative features could justify their higher valuation. But if you're looking for a short-term rally, another 50% short-term rally by the end of 2023, you'll likely be disappointed. Adobe is looking to be more of a long-term play on cloud and artificial intelligence markets. So pretty interesting article. They touch on a lot of key points, and it's definitely very informative. And we'll look into their financial statements to look at their financial health right here. We can see their income statement right here. Total revenue increased about 10% year over year, as the article pointed out, from 4.3 billion to 4.8 billion in the second quarter of 2022 to 2023. And on top of revenue growth, they also had net income growth about from 1.1 billion to 1.2 billion. So that's also around 9 to 10% net income growth. Right here in their balance sheet, they're comparing June 2nd to December 2nd, 2022. During that period, total assets are up from 27.1 billion to 27.8 billion. And then we can see they finance the majority of their business with equity. And of their equity, they had retained earnings that increased from 28 billion to $30 billion. Then lastly, for their operating cash flow, we can see right here it increased from 2 billion to 2.1 billion year over year. And they repurchased about $1 billion of common stock, which is down from 1.2 billion in the second quarter of 2022. But they are still prioritizing returning value back to shareholders, as you can see right here. And so right here, this is a discounted cash flow model to figure out the intrinsic value per share for Adobe. Yahoo Finance is estimating that the company is going to grow at 14% for the next 5 years compounded annually. They had around $7.4 billion of free cash flow in their most recent full year. They have a little over $2.4 billion of cash sitting on their balance sheet after subtracting debt. And they have 458 million shares outstanding. That puts their estimated intrinsic value per share at a little over $300 per share, which means that at the current share price, Adobe is currently trading above their estimated intrinsic value per share, since they're currently trading at close to almost $500 per share. So that would put them at a slight overvaluation. And then if I go to the right-hand side here, we can see that Adobe right here in their competitor analysis is being compared to Google and Oracle. We can see in comparison, they have the highest gross profit margin, the highest net profit margin, highest return on assets, and they have the highest PE ratio as well. Oracle is the only company that pays a dividend. They pay out around $1.28 for every $100 that you invest into Oracle. But based on this, it looks like from a profit margin perspective alone, Adobe is obviously very dominant. If you wanted to go for a company that had the best profit margins, it would definitely be Adobe. Based on PE ratio, it looks like Google is trading the cheapest. And if you wanted a company that pays a dividend out of these three, you would definitely want to go with Oracle, because Adobe and Google don't pay a dividend. Then to end off the video, I've created a couple of charts to compare Adobe to some of the other companies we've looked at in past videos. We can see that for share price compared to intrinsic value, Adobe is currently trading at $470 per share, and their estimated intrinsic value per share is $310. So they're basically trading at around 1.5 times their intrinsic value per share, which is not good enough to get them onto the table here. The number 10 spot is Meta, trading at around 1.3 times their intrinsic value per share at the time of making that video. As we can see right now, Google, Alibaba, General Electric, and Etsy are the only companies we've looked at that are trading below intrinsic value per share. And then we can see right here the three tables that I recently added that I'm going to be adding to all of the future videos here. We're going to be comparing the top 10 companies that we look at for dividend yield, for year-over-year revenue growth, and year-over-year net income growth. And I'm going to be doing these tables by quarter. So we can see right now it's going to be quarter two. When the third quarter comes, I'll do that for the third quarter, and so on. But we can see that for the growth rate, Adobe has a 14% growth rate for the next 5 years, according to Yahoo Finance. That puts them in the 10th place spot on the growth rate table. For profitability, Adobe had an 86% gross profit margin, which puts them in first place against all of the companies we've looked at for the gross profit table. And they had a 27% net profit margin, which puts them in third place for the net profit table. That we can also see that these tables are new, so obviously Adobe is the only stock currently on these tables, but I will add more companies to these tables as we continue to make more videos. And then lastly, we can see for the stock performance chart over the last 5 years, Adobe over the last 5 years has returned about 90% for the last 5 years. So that would be good enough to put them into the 10th place spot. I'll have to replace Pepsi and put Adobe there. We can see that Tesla holds the #1 spot with about a 1,000% return over the last 5 years. So based on this, it looks like Adobe is very competitive. They made it onto the stock performance for the last 5 years chart. They are one of the more profitable companies we've looked at. They have a decent growth rate, but unfortunately at the moment they are not trading below intrinsic value per share according to the discounted cash flow model. And we can see that compared to their competitors, they have some of the highest profit margins in the industry. So at the moment, it looks like Adobe might be overpriced based on what the article is saying and based on the fact that their PE ratio is a lot higher than their competitors. But their company is profitable and they have some very interesting catalysts that are coming up, including their acquisitions as well as the introduction of their AI software. So it'll be definitely very interesting to see where Adobe goes from here. Let me know in the comment section down below what you guys think of Adobe. Leave a like on this video, subscribe to the channel, and I'll see everyone in the next one.